All right, let's dive into one of the most fascinating concepts in investing, the growth paradox. We're going to break down why the companies that could become the biggest winners of tomorrow often look like the absolute worst investments today. Let's get right into it.
This quote just perfectly captures the tension, doesn't it? It's like two people are looking at the exact same picture and seeing completely different things. One side sees all the traditional warning signs flashing bright red, screaming danger. The other side, they see a glimpse of the future, a massive opportunity that everyone else is just too scared to touch.
And look, this isn't some abstract theory. Let's just hop in a time machine back to March of 2000. If you looked at the numbers, General Motors was the safe, smart bet. I mean, it was making money. Its PE ratio was super low. It looked like a total bargain. And then you had Amazon. It was losing money hand over fist, which means its PE ratio was literally infinite. By every metric in the book, it looked insanely, ridiculously overpriced. But here's the punchline. If you had ignored the smart choice and bet on that insane idea, that Amazon investment, over the next couple of decades, it would have returned a mind-boggling 4,000%. Meanwhile, a lot of those so-called bargains of the day, well, they either fizzled out or disappeared completely.
And that right there, that's the paradox we're talking about. This is the absolute heart of growth investing. You have to understand that if you're hunting for the true game changers, the old rulebooks for figuring out what a company is worth, you might as well just toss them out the window. You need a completely new lens to see the world. So let's jump into our first section. How do we do that? How do we tell the difference between a company with real, sustainable, game-changing potential and one that's just riding a wave of temporary hype? Okay, this is probably the biggest trap people fall into. They see sales numbers shooting for the moon and they think, wow, that's a winner. But hold on. If a company is burning through $2 on marketing just to get $1 new of revenue, they're not creating value. They're lighting a bonfire of cash. So how do we spot the real deal? Well, it really boils down to these three things. And I promise, these aren't just fancy finance buzzwords. They are the absolute foundation of any great growth company. First up, ROIC. It sounds complicated, but the idea is actually super simple. It just asks, for every single new dollar the company plows back into the business to grow, how much profit does that dollar generate year after year? The truly elite companies, the compounding machines we're looking for, they generate more than 30 cents of profit for every dollar they reinvest. That's a powerful engine. And this chart just shows it perfectly. Think about a software company like Adobe. Once the software is built, adding a new customer costs them practically nothing. So their ROIC is huge, often over 50%. Now compare that to a big retailer. To grow, they have to spend a fortune building new stores, buying inventory. It's a massive investment for a much smaller return. This is why the economics of software are just so incredibly attractive. All right, pillar number 2. It's not enough for a company to be efficient, it also needs room to run. I mean, a company growing at 40% a year sounds amazing, right? But if their total market is tiny, that growth is going to slam into a brick wall sooner rather than later. You need a long, long runway. And you got to be a real skeptic here, because companies will always show you these ridiculously huge market size slides. You remember Peloton, right? They basically claimed their market was every person on earth who had ever thought about exercise. The reality? It was a much, much smaller niche. A good analysis cuts through that hype. And the truly legendary companies like Apple with the iPhone, they don't just grab a piece of the pie, they bake a whole new one. And finally, all that growth means nothing if a competitor can just waltz in and steal it. A great company needs a moat, a competitive advantage that actually gets wider and deeper the bigger the company gets. Think about it. The more of your friends that are on Facebook, the more valuable it is for you to be there too. That's a network effect. It's a powerful, self-reinforcing loop that's incredibly hard to break. Okay, so we've found a company that checks all 3 boxes. It's efficient, it has a huge market, and it has a strong moat. But it still looks really expensive. So if we can't use a PE ratio, how in the world do we figure out what it's actually worth? Well, for software businesses, there's a really neat little shortcut called the Rule of 40. It's a quick sanity check. You just take their revenue growth rate and you add it to their profit margin. If the total is more than 40, it's a pretty good sign that they're balancing that aggressive growth with real profitability. It's a great way to avoid those cash-burning hype machines we talked about earlier. In this chart really hammers home why you have to be willing to pay up for high growth. I mean, just look at this. These two companies make the exact same amount of money today. But because Company B is growing so much faster, its value right now is worth more than double Company A.
That premium price isn't just wishful thinking. It's the mathematical reality of what that future growth is worth today.
So now let's talk about putting this all together. How do you actually build a portfolio of these kinds of companies? Because, let's be honest, investing this way comes with its own unique set of risks, and you have to manage them smart.
Now, this might be the single most important statistic for any investor to understand. Think about that. Of thousands of companies, just a tiny sliver, 4%, are responsible for all of the stock market's net gains over time. The rest, on average, are basically a wash. This tells you something huge. Your goal isn't to pick a bunch of decent stocks. Your goal is to find and hold on to just a few of those incredible winners.
So a really smart way to do this is with a tiered portfolio. The biggest chunk, your core, is made up of the proven winners, the NVIDIAs and Microsofts of the world. Then you have a tier for those faster growing, but maybe less proven companies. And finally, you have a small speculative slice for those high-risk moonshot ideas where just one big hit can more than pay for all the ones that don't pan out. It's a great way to balance stability with that massive home run potential. Okay, we've talked strategy, we've talked analysis, but we've saved the hardest part for last. And that's managing the one thing that can wreck it all, your own brain.
Let's go back to Amazon for a second. To get that incredible, life-changing gain, you first had to live through your investment getting obliterated. Down 95%. Can you imagine that? Sticking with it through that kind of terrifying freefall? That is the real challenge. The biggest winners are almost always the wildest rides.
And the data shows most people just can't handle it. The average investor gives up about 3.5% in returns every single year compared to the market. And why? It's simple. They let their emotions take over. They panic and sell at the bottom, and then they get greedy and pile in at the top. It's a devastating, self-inflicted wound. So the takeaway is you need a plan to protect you from yourself. That means never letting any single stock become so big that a 50% drop would make you lose sleep. It means always having some cash on the sidelines to take advantage of those scary moments. And it means training yourself to focus on how the business is doing, not what the crazy stock price is doing day to day.
At the end of the day, this is what it's all about. This is the magic of growth investing, the asymmetry. Look, if a stock goes to zero, the most you can lose is 100% of what you put in. But the upside, it's limitless. One single stock that goes up tenfold can wipe out the losses of 5 or 6 that failed completely. The whole game is about finding those big winners whose gains will dwarf all the little losses along the way.
So we'll leave you with this question. The next Amazon, the next NVIDIA, it's out there somewhere right now. And I guarantee you, to most people, it looks overvalued, it looks risky, it probably looks a little bit crazy. The real test is, do you have the framework to spot its hidden potential? And maybe more importantly, do you have the nerve to hold on for the ride?